The psychological cost of checking your portfolio multiple times a day. At first, it feels harmless. Just a quick look. Just staying informed. But behavioral research suggests that repeatedly checking your portfolio during the day carries measurable psychological and financial costs. Here's what science says. 1. Myopic loss aversion. More viewing equals more pain. Economists Shlomo Benartzi and Richard Thaler introduced the concept of myopic loss aversion. Their research shows the more frequently investors evaluate outcomes, the more often they experience short-term losses, the more risk-averse they become. Markets fluctuate constantly. Short-term volatility is normal, but frequent checking magnifies perceived losses. More exposure, more emotional pain, more conservative or reactive decisions. 2. Dopamine conditioning and behavioral addiction. Every portfolio check creates anticipation. Am I up? Did something move? Is there news? This anticipation activates dopamine circuits. Over time, the behavior becomes reinforced. Check small emotional spike, repeat. Neuroscientist Kent Berridge distinguishes between wanting and liking. You may not enjoy checking, but your brain starts wanting to check. This creates a habit loop similar to social media refreshing. 3. Increased stress hormones. Research from University College London shows that financial uncertainty increases cortisol levels. Frequent checking means more exposure to uncertainty, more exposure to micro-losses, more stress spikes. Chronic small stress responses accumulate. Even if each fluctuation is minor, the physiological toll adds up. 4. Attention fragmentation. Each portfolio check interrupts cognitive flow. Cognitive psychology research shows that task switching reduces productivity and increases mental fatigue. When you check prices, attention shifts. Emotional evaluation occurs. Mental energy drains. Repeated micro-interruptions reduce deep focus capacity. The cost is invisible but real. 5. Narrative distortion. When you check multiple times daily, the brain builds stories. It was higher this morning. I should have sold. I missed that move. Psychologist Daniel Kahneman explains that humans evaluate experiences through narrative construction. Frequent checking increases counterfactual thinking, imagining alternative decisions. This fuels regret and second-guessing. 6. Illusion of control. Frequent monitoring creates a subtle illusion. If I watch closely, I can manage outcomes. But most long-term returns come from asset allocation, time in the market, discipline, not minute-by-minute reactions. Monitoring feels like control, but often it's just observation. 7. Financial cost. Reduced risk tolerance. Because volatility becomes more emotionally visible, investors who check frequently often reduce equity exposure, sell during dips, trade more frequently. Data consistently shows excessive trading reduces long-term returns. The psychological cost eventually becomes a financial cost. The hidden price. Checking your portfolio repeatedly costs emotional stability, cognitive energy, focus, risk tolerance, long-term performance. The market fluctuates whether you look or not, but your nervous system reacts every time you look. Practical solutions. Define a fixed review schedule, weekly or monthly. Remove trading apps from your home screen. Turn off price alerts. Automate contributions and rebalancing. Ask, has my long-term thesis changed? Often, the best way to protect returns is to protect attention. Less checking, more compounding.